And I'd like to welcome you guys back to another episode of the Wealth Wise Guru. And I'm your host, John Chaff. And it is Monday, March the 10th, 2025. And as you can see, investing this morning is $655. Portfolio is down this morning by $2,000. You have to have a buying power of 3,100. Let's see, as of today, the U.S. stock market is experiencing significant decline due to heightened recession fears. Okay, today the U.S. market is facing notably declines, primarily driven by concerns over potential recessions following President Trump's comments. The technology sector is particularly hard hit with major stocks like Tesla and Nvidia seeing substantial losses. Additionally, the energy sector is under pressure as crude oil prices fall. Treasury yields have also declined, indicating a shift towards safer investment as investors react to the uncertainties in the market. Overall, the combination of the economy feels sectors specific challenges in contributing to the market downward trends. Let's see. Maybe I need to read that again. Let's see. Treasury yields has also declined, indicating a shift towards safer investments as investors react to the uncertainties in the market. Overall, the combination of economics fears and sector specifically challenges is contributing to the market downward trend. And here's your up and coming events. Starting with March 15th, we have the Federal Reserve meeting. The Fed's decision on interest rates could significantly influence market segments and investors' confidence. 3:20 earnings report. Key companies will report earnings which may impact stocks prices and sectors' performance based on their results. And 3:25, the economic data release. Up and coming economic indicators will provide insight into consumer spending and inflation, crucial for market directions. And what's happening today in the market? Tesla versus BYD. Tesla stock crashes over 50% from the highs as Elon Musk worries mount. Tesla stock has plummeted as concerns about Elon Musk's impact on the brand grow, while BYD sales surge. The decline is significant as it reflects investor segments and market dynamics in the EV sector. Astonishing 1.57 trillion wipe off Meg 7 since the start of 2025. The tech sector has experienced volatility, leading to a significant drop in share prices for major companies like Nvidia, Tesla, Amazon, and Apple. These losses highlights the fragile of the tech market and investors' concern. And that's going to do it for your morning brief. And so we are definitely taking a hard hit with this new administration and the way they have come out with different policies, these tariff policies, and then you got Elon Musk. He's all in the political arena, and actually the corporate in the political arena does not match. And so as soon as Elon get his stuff together and realize he's gonna have to choose one or the other, or he's gonna be fired by his own company. Because the board of trustees do not play when you come to doing something that's going to hurt your company. And yes, you can be fired by the very company that you own. You can ask that guy. The guy's name was I forgot his name, but he was the founding father of Men's Warehouse. And that company, his own company fired him. I'm quite sure it set him off on a nice package, but his own company fired him. So the Elon Musk thing, get his stuff together, he gonna suffer the same fate. Let's look at Tesla. I got 12.71 shares. Let's see. 12.71 shares of Tesla, and it's down by $28.24. And it's down. I'm down now, just under $300. I lost already just today $359. A total of $132. And this is just across the board of many companies that I own in my portfolio. And this is the reason. Now my stock was at almost $80,000. It was at $77,000, and now it's back down to $58,000. So that's 6, 7, 8. So that's $30,000 loss. The thing about when you lose like this, when your portfolio is down, as long as you don't sell when it's down, then it can go back up. But if you sell while your portfolio is down, then you lock in your losses because you sold while the portfolio is down. And so I'm actually down today alone almost $3,000. But now's the time for, if you have money on the sideline, to be buying in these stocks, because they're going to rebound. They're going to go back up. because they was really expensive. I think Tesla. A Meta platform, Facebook. I think it was at by almost $700 a share before it dipped. Now it's down $29.70 today. Price is $595.79. I own 1.7 shares. So you can either buy it or you could put a leap option in on this particular strategy, and you can go trade and hit trade options. And you go select your date, and you can go out to March of 2026. You hit buy and call. Well, like I said, this stuff is going to go back up. That's what it's designed to do, to make money. And this is current striking point, $595.71. Anything below it, because it's a call, means it is into the money. And then anything above it, that current striking point, means it is out of the money. And so you usually want to stop when it's a leap. And a leap means it's a year or more. When it's a leap, it'll go into the money, and then they go out of the money. So that's why I always say you just pick out of the money, instead of picking into the money. If you go into the money, then it's gonna creep over into the out of the money, and then you're gonna start losing. So you just go ahead and click out of the money. Let me look at 600. Gives us a 30.54% chance of profit. That's a nice delta of 601.09. And the theta is 1487. Volume is 58, means there are 58 contracts currently in place. And then also 437 other that are interested in this particular strategy. Volatility is not too bad. The IV is 38.94%, 84%. And so you would click buy. Wow. Look how much it'll cost you to own this. You'll hit 1. Then you'll put the 101.70. And as you can see, it costs $10,000. Even I can't afford this. This is you can tell when you can make a lot of money on some of these strategies when you have big when it costs you a whole lot of money like this. So it goes to what? It goes to 5,000, and then it goes to unlimited. Unlimited profit starting at $50,000 for this particular strategy. But it will cost you $10,000 just to invest in this. The thing about it, this gives you control over 100 shares of this particular stock. And so I would need $8,617.78 just to cover this particular strategy. And so I'm not gonna spend that kind of money on no stock. I can buy a whole lot of stock. Doing that kind of things. So what you can do is go back up to current month, which is March. Then you can go to click on April 17th. You're gonna hit buy and call. Again, this is the current striking points, 592.76. So let's look at 595. If you look at 595, it gives us a 52.97 delta, and that gives us a 53. 32% chance profit, 85 volume, 546 interest, and a volatility of 42.76. So you close that out. And then we're going to hit that plus sign. And you hit the plus sign when you're going to be adding to that particular strategy. So we're going to go back up to the top. Wait a minute, did it wrong. I always do that. You start out first, you do a sell call. You do a sell call. This is the current striking point. Anything below it is is into the money. Anything above is out of the money. And so we're going to hit 595. That gives us 53 delta. Chance of profit 67.40. Volume is 85. Open interest 546. Volatility 42.67. So we'll close. And see, you couldn't even buy this if you don't own 100 shares of it. But this particular strategy I'm going to show you, you can buy it even if you don't own 100 shares of it. And again, this is called the iron corridor. And you're going to be adding the plus sign, telling the system that you're going to be adding to it. You're going to go back to the top. You're going to hit buy instead of sell. And then you're going to go one leg up, which is 600. That gives you a 50 delta. Chance of profit 31.27. 876 volume. Interest of 1751. Volatility 42.40. And then we're gonna plus hit that plus sign now. Then we're gonna go back up and hit sell. Sell again. And then this time we're gonna hit put. And then we're going to go just below the striking point, which is 592. We're going to look at 590. That gives us a 45 delta. Chance of profit 64, 52%. Volume 16. Open interest 180. Volatility 44.79. And then we're going to hit that plus sign. Then we're going to go back up top, hit buy. We're going to go one leg below it, 585, and give us 42 delta, 43 delta, 34% chance profit, 34 volume, interest 59, and volatility 45. And then we just add that plus sign. We go down here and hit this. And this is what you call a iron corridor. Let's see. It gives us $177 in profit. That's what the leg looked like. Let's see again. This ain't adding up right for some reason. No, it's saying 4 options order, but it should be saying iron corridor. All right, let's try this again. Just in case I missed something. We're gonna hit clear. We're gonna clear that out. I might accidentally hit something. We go back up and hit April 11th. We're gonna hit sell and put. And we keep scrolling up until the current share price started to move up, which is this right here. Okay, we're going to hit the plus sign. Let's see. Yeah, we hit the plus sign there. Then we're going to go here and hit buy call. Hit the plus sign now. Then we're going to hit sell, put. We're going to hit the plus sign now. And then we're going to hit buy put. Okay, now we got you. Now we cooking with grease. If it doesn't say iron corridor, that means you did something wrong. So you just have to go back and redo it. Okay, this chance of profit 385. And here from the black dot to green dot, that's your profit. This is one leg, $380. This leg here is insignificant, doesn't matter, it doesn't even count. Only from the black dot to the green dot. So that's two legs for $380 a piece. This is your losses, $130 on this leg, and 140 on this leg, 130 on this leg, 120. We have to keep changing with it. This area here is insignificant, and this leg here is insignificant. So you hit review. Estimated credit will be 477. So you can either put yourself on 1 up there, or if you want to increase your profit, you can put a 2. And so now the profit is maxed out now to $960. And then you go here and you put in your limiting price. All right, let's see, it'll go 4.80. We'll just say high. We'll say low likelihood now, so we'll change that to 3.75. And it gives you a credit of $749. And not only do you get a chance to keep that credit, if the current striking point does not reach the share price that you set, not only do you get a chance to keep that credit, but you also get a chance to keep that shares. If it does hit, then you also get a chance to keep the credit, but you have to give up your shares of that particular stock. So you will hit review, and then you submit, and then this one will cost me, of course, $1,000 in collateral, plus $749 is what I would be spending if I was to implement this particular strategy. Okay, let's see. And I know that I see the market is down all over the place. You guys have to be careful about trying to put these puts in, because you're trying to anticipate something. Because I tell you, you put a put in, you must try and get pre-assigned. You get pre-assigned to one of these puts or one of these companies, and you're going to have enough money to cover 100 shares of that particular company if you get pre-assigned. If you do not have it, then your portfolio is going to be upside down. Meaning you ain't going to be able to buy, sell, or trade until you resolve that issue. Just say if we want to buy 100 shares of Apple, we go up in here, make sure to click on shares, type in 100. See, that Apple? No, that's Google. That's Google. Wait a minute, hold on. Okay, so 100 shares of Google will cost you $16,548. So if you put in a put, just say you went out, let's say the 2 months. This is March, April, May. Let's say May. May 16, you put in a put. You put buy and put. Current price is 165.63, and let's say you go all the way down to 150. I guess you got 23.80 delta, 23% chance of profit, and 174 volume, 3,278 open interest, volatility of 39.61. You can either add it to the watch list, or you can just buy it. If you buy this, then you'll put your put your 1 there, and then here you put in 4.30. All right, this, a lot of you guys look at this profit. That's max profit. That's max. Chances are just falling down till you reach the max or slim to none. So you guys have to quit looking at that. Because I see a lot of you guys on Facebook doing this. And you put in these different, only thing you doing is put in different scenarios. It's not actually true. The truth is what you're seeing out on the screen. It's your profit right here. See, this is your profit. And that's your max profit right there. And like I said, the only way you'll get that is the company was to fold or something. And Google ain't finna fold no time soon. So you'll hit review and say, I'm paying $430 for the right to sell 100 shares of Google for $150 by May the 16th. If Google shares aren't $150 or lower by May 16th, this option will expire worthless. So it'll cost me $430 to implement this particular strategy. And so you got, then once you implement it, you got to watch it to see what it does to make sure it doesn't go against you. Because it can go against you. And you can end up getting pre-assigned. And the pre-assigned is not a bad thing if you want to own that particular stock. You just got to make sure you have the funds to cover that. And if you don't have the funds to cover it, then like I said, you're gonna have to get Robinhood to step in and to figure out something. And I have gotten pre-assigned 2 or 3 times, and Robinhood stepped in and got me out from under it. I have made thousands of dollars getting pre-assigned. I have lost thousands of dollars because pre-assigned, like I say, you get pre-assigned on a stock, and it's 100 shares of that particular stock. And 100 shares of that particular stock could be $27,000, or it could be $50,000. Just depends. So that's the price you had to come up with. Then if you don't come up with it, then they will sell it off, and then maybe you might have like a $500 or $200 or maybe $1,000 or $2,000 profit from that. But you're not going to be able to keep that those 100 shares of that particular stock in your portfolio. And then just say if you was able to keep it in your portfolio, you did have the funds to cover it, then you turn around and do what you call a poor man strategy on it. It's poor man cover call. And then thereby building yourself up a side income just by placing poor man cover calls. And just because you don't see me implementing these strategies online doesn't mean I won't go back and do it. I just don't do that. I just try not to get in too big of a haste and doing stuff online. And so you got Home Depot. It's at $378.83. You just continue to buy these stocks because they're going to go up in value. Amazon, everybody's down. Everybody's down today. Amazon down $6. You put in a put, Amazon is down today. And you put in a put and the only thing be up tomorrow. Next thing you know, the strategy is starting to go against you. That's why I always say time in the market beats trying to beat the market. Time in the market would you be just buying a share of it. No matter if it's what is green today or red tomorrow, you're just buying a share, and you keep doing that until you got a significant amount in your portfolio. That way, if it does go down, you can still weather the storm because you have such a nice size portfolio. See, I still have 58,000 in my portfolio, even though I lost 30,000. But like I said, as long as you do not sell when the stuff is down or when it's in the red, those stocks can come back. They come back simply because you still own it. And so that was Google at 17,000, and Nvidia right now it's at 16,000, even though it's down. I still own 126 shares of it. Today is negative 600, total 1,800. So you just click and buy one share. Okay. And then you just implement that. That's all it takes, and just keep doing it. Keep doing it. No matter what the price, what it's doing, whether it's red today or green today, you just keep buying it. Keep buying it. Don't pay attention to what it's doing, what it's presently doing. And it's still putting puts. And this is what you need to be doing. Buying bonds, government bonds, yields. This is for safe haven. Here is where you want to be putting your money. And Bisco QQQ. And let's look at what's in this phone. So you got technology, consumer clerical, healthcare, base material, and communication service, consumer defense, industry, and utility, real estate, financial, and energy. So that's all you have to do is just put your money here. If you're afraid of what the regular market is doing, the S&P 500, even though it's down today, but it's still a safer place to put your money than just buying naked stocks or naked shares. And then you got Vanguard, Vanguard stock market ETFs. Even though they are down, but they're going to go back up. Some of them, these are high dividends ETFs. Schwab USA is a nice stock to have in your portfolio. See, they aim at $28.62. See? That's all you gotta do is just keep doing that, and then you don't have to have as many in your portfolios as what I have. It only takes 3 to 4, 5, or 6 stocks to have in your portfolio to build up yourself a nice portfolio. Berkshire Hathaway, they always up. They always making money. So Warren Buffett, boy, his company. You can't get no better stock to be invested in than this company here. I had never seen them down. And when everybody else down, they up. And even if you can't afford just the whole share, just do a dollar amount. So every little bit helps. I'm gonna show you guys one more thing, then I'm gonna get you guys out of here. Show you the features again. Features is a little bit better than options, because features you don't have to worry about getting pre-assigned. So I'm going to have to look at that. Let's see. Features. And features are down too, but you buy low and then sell high with features. A good way is to you hit that, and then you hit trade, and then you hit ladder. And then you go up here and you see what this doing. And you hit whichever target point that you want to hit. Just say right here, it's 47. You just hit that, and then you hit sell. Okay, in this case, you have to have a certain amount of money in order to cover this particular strategy. That's the thing about features. You got to have that money to cover that margin. And so when you hit this, well, let's go back to another one, a little bit more cheaper. Let's see. Crude oil. You hit trade, hit ladder, and then you just set your striking point. Just say I wanted to, you got 15 orders in place right here. Just say I wanted to do that. Then you hit sell. And then say you'll have to have $908.08 to cover this particular strategy. And just by you hitting this, when the stock rises up to this point, it's going to automatically sell. It's going to automatically kick off a sale. It's a limiting sale. It's going to automatically kick that off when you set that. So you don't have to worry about keep coming back and forth looking at it. Because once it gets to that point, it's going to automatically kick off in the sale. Then it's going to tell you that that particular strategy has sold. And sometimes doing futures actually better than doing options, because you don't have to worry about no pre-assignment or anything like that. Let's see, I got a warning about invalid call getting pre-assigned. I can't remember which one was it. Okay, well, we're gonna bring an end to today's video, so I can look at this better. And again, we thank you guys for watching and tuning in. And we will see you in the next video. Okay, well, you guys enjoy the rest of your day. And we'll see you bright and early on Tuesday morning at the opening of the bell. Be safe out there. And God bless and thank you for watching. Baby, let's cruise.